Hello and welcome to Friday's rendition of the Engine Room podcast brought to you by tokenmetrics.com. I am your host with the most, Jacob Koch-Gallup, and I'm joined by Mr. William Noble. How you doing?
I'm doing good, sir. Thanks for having me.
Yeah, of course. Glad to have you here. So we can get right into the news of today. So I want to bring up this article from CNN Business. I thought it was kind of funny. Maybe they were trying to make crypto players nervous, but the headline was how cryptocurrencies could trigger a financial crisis. And so what this is from is it's a new report from the Financial Stability Board, an international body that brings together regulators from 24 countries and jurisdictions, said that the fast evolving crypto market could quickly reach a point where it becomes a, quote, threat to global financial stability. So they're pretty much calling out policymakers saying you need to step up. This is going to cause so much instability. And the reason why they released this report now is because all these banks and big market players are ramping up their exposure to crypto. And also this is because a lot of their clients are saying, hey, get us into crypto. Please give us exposure to crypto because the clients can see how profitable it is. So these big banks are listening to their clients. And I think they also brought this up because we're going to talk about this a little later, but on Thursday, Bitcoin plunged 8% and there was a broader crypto market sell-off. So they're showing, I mean, yes, it is volatile, but I think there's something also at play here that a global financial board is saying, oh no, crypto's going to cause major problems. And they also even compared it to the 2008 financial crisis. They said, as in the case of the U.S. subprime mortgage crisis, a small amount of known exposure does not necessarily mean a small amount of risk, particularly if there's a lack of transparency and insufficient regulatory coverage. So they're pretty much drawing exact comparisons between the financial crisis and crypto.
Yeah, fascinating, right? So it's wonderful that someone would say, gee, if the government doesn't control it, it could create a crisis. Really? Okay, that's not true. The whole purpose of crypto is to give people an option other than currencies issued by governments. So that part sounds like whining. Now let's shift over to a financial crisis because I was in the market during the great financial crisis. And here's how that worked. Big banks had billions upon billions of dollars of toxic assets on their balance sheet, right? They were dependent on whether consumers would make their mortgage payments. And when people stopped making payments, all these big assets, right, started to blow up, right? So the banks blew up. The people who had loaned money to the banks started to blow up. And it was this huge reaction. But the key is the reaction was created because the balance sheets, the amount of assets owned was huge. It was disproportionate. So really the only company right now that has a disproportionate amount of Bitcoin on their balance sheet relative to what they do is MicroStrategy. And that's not a bank, that's a computer company. So, crypto is worth $1 trillion or $2 trillion total, yet the stock market is worth 2.5 times the US GDP. So here's the total value of stuff that we make and the total value of the stock market that's supposed to reflect the value of stuff that we make. So if there's going to be a financial crisis, it's going to be in equities or maybe bonds, certainly not the teeny weeny world of crypto as it relates to the size of the legacy markets.
Yeah. And I think that's one of the many important points you brought up is that they had so much of these junk bonds on their balance sheet in 2008, 2007. I mean, they were taking these triple B shit bonds and bundling it together, putting a little nice ribbon on it to get it triple A rated, the highest quality rated bonds, and then just having that all on their balance sheet. So that's not the same as crypto. I mean, obviously you have a lot of shit coins. There are a lot of rug pull, pump and dump coins, but these big banks, these large institutions, they're not putting Squid Coin on their balance sheets. They're putting Bitcoin and Ethereum and a few other of the blue chip cryptocurrencies. Like this is not the same thing as triple B junk rated bonds that happened in 2007, 2008. So I think it's a lackluster comparison. It's not one that should be made lightly. And I think the reason why they compared it is because they're scared and they know it threatens them.
Yeah, I mean, to be fair, if there was ever a problem with something like Tether, right, that could create a risk to the crypto DeFi system, right? But the overall financial system is not tied to Tether, right? I mean, back in 2008, I was working for Goldman at the time. A lot of people don't notice, but the reason these other investment banks were buying the toxic assets or the high yielding assets and taking the risk was to try to keep up with us on the earnings front, right? So, you know, the FOMO that occurred in junk bonds was, or toxic assets or mortgage related securities, is nowhere near, like I said, the dollar amount. Even if people have FOMO'd into crypto, it's like it's not apples to apples. It's like apples to blueberries, right?
Yeah.
Crypto's the blueberry, and the apple is the stuff that blew up the market in '08.
Mm-hmm. Mm-hmm. Yeah. So I think that's probably enough negative crypto news for today. Now let's bring on a little bit of hopium. This is a tweet from a major, what's his title at Fidelity?
I believe he's a major macro analyst.
Here we go. Director of Global Macro
Right.
at Fidelity, Jurian Timmer.
Right.
So yeah, if do you want to explain this?
Sure.
This tweet? Yeah.
So once upon a time, right? Because I was around when like cell phones and the internet was emerging. Okay. They would talk about measuring tech stocks using adoption rates of the internet, adoption rates of cell phones. Now, right now, you're laughing at yourself going, what? You mean everybody didn't start using cell phones and the internet right away? Actually, no, right? Usage built up over time. So what this analyst did was he says, all right, let's go back and let's plot how people join the internet, how fast they join the internet, like, and then the same thing with cell phones, right? How quickly did people adopt those networks? Now, what he's saying is the Bitcoin network is like the next cell phone internet thing that everybody's going to be looking at as a must have. So he says if Bitcoin is a must have like cell phones or the internet, then Bitcoin usage and price should grow like cell phones and internet. So when we looked at the graph, it seems reasonable, right? Like 3-4 years out, he says, maybe 100, 150K, maybe, 8 years out, he's talking about, 500K. And these are numbers that you've heard, right? And then, of course, it's interesting that he does actually use data to come up with like a 2040, 2038 target of 10 million. So, when you hear the Michael Saylors of the world and people on YouTube throw those numbers out, you sort of tilt your head. So this guy gets credit for two things. One, he put some context to like the hyperbole numbers and made them, not hyperbole. The second thing he did is just put the long-term vision in context, right? Like if Bitcoin goes to 34K or 25K, not only is that not the end of the world, but he considers it noise, right? Because he's thinking long-term. So the net for crypto people who are listening to this on YouTube or on a podcast is, yeah, okay, crypto's shitty now. Yeah, people are saying negative stuff about it. Yeah, it may go down with stocks and blah, 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 blah. But where's it going to be in 5 years and 10 years is how you should be thinking when you're afraid. So this is like cryptotherapy and fear management.
Yeah, I think that's important for a lot of people. It might be to make a quick buck, but obviously, looking at this chart, if it does follow growth rates of mobile phone users, internet users, if you hold 10% of one Bitcoin and it goes up to 10 million by 2040, that's 18 years. You're gonna be a millionaire. So
Right.
yeah, definitely something to hold on to.
Right.
HODL
It's
is
about the network, right? Whether it's
yeah.
Bitcoin or altcoins, it's about the adoption rates of the network, right?
Mhm.
So if you think of a digital asset as software or a computer network, right? It's just a question of time before two things happen. One, people adopt the network, and two, institutions are comfortable investing in the network, you know, like they're comfortable with Google. Why wouldn't they be comfortable with another computer network? It just has to do with money.
Yeah.
Now, regulators may have to bless it a little. I get it. There may have to be some sort of, sanctioning and say, blessing for digital assets. But this guy's saying, blessing or no blessing, it's going up
Yeah,
long term.
and I think it's important to note this guy's not like the head of crypto research at Fidelity. We do know that Fidelity is bullish on Bitcoin. They've been mining Bitcoin, but this guy, this is not like some guy like trying to pump his own bags. Like he's the director of global macro research at Fidelity. So yes, they do like crypto, they do like Bitcoin, but this guy's not like out there pumping NFT projects, pumping random crypto projects every day on Twitter. Like he's um
Right. He's probably the number one legacy based analyst, probably along with Tom Lee from Fundstrat.
mhm, mhm. Yeah, and so I think we can move right along to Mike Novogratz's tweet. And if you want to explain this a little bit too, because I know this affected you as well, and
Right.
I think it goes along the line of hopium and kind of some risk management.
Right. It falls under the category of it happens to the best of us. So to condense it, Mike Novogratz, head of Galaxy Digital and fellow ex Goldman employee, was responding to a tweet from a guy that basically said, Bitcoin's horrible, it's going down. The only alternative is gold. Wake up, booga booga booga. Then on an update in Bitcoin on February 15th, you know, Mike tweets out, hey man, it's not gold or Bitcoin. It can be gold and Bitcoin. You know, don't go hating on crypto. And I saw that on an update and I was like, okay, well, maybe we got another bounce in crypto. Maybe we got another leg up at the end of the month. So, Mike stuck his neck out there and said something positive about Bitcoin. I stuck my neck out and said something positive about Bitcoin on YouTube. And guess what? 2 days later, well, we got effed,
Yeah,
right? And the lesson for people listening to this is, it happens to everybody. It happens to the best of us, right? The old, the young, you got trapped. Okay, you got trapped. You have to go with the motto, so what? Now what? There's always going to be crypto haters, right? There's a difference between being a crypto hater and just navigating what's happening in the market now. So you learn from your mistakes, right? And then you plot the future, right? For your trading, your investing, right? You have a short term thesis and then you have a long term thesis, right? But if you got hosed this week, you're not alone.
yeah, yeah, and I think that's something important to bring up is that like the handling your emotions is super important just in any investing. And I definitely struggle with this sometimes. I get attached to a project. And I don't want to sell even if I'm up 2-3x. But also it's the same time. It's like, okay, yes, Bill, you got burned in this flash crash that happened on February 17th. But at the same time, if we take a look back at the chart from before, okay, you got burned buying it at 35 instead of 34, or now dipping, or excuse me, is it 43?
Right. Yeah. I mean, it was like 42, 43 when Mike came out with the tweet. It rallied to 45.
Yeah,
Right.
45. And then now
And
it just dipped below 40.
right.
40K Bitcoin. And so it's like, yeah, you bought it at 45 instead of 40K, but in 12 years when it's $10 million,
Right.
what's the difference of 2 to 3K?
Right. And then to add some color to the story, I talked on YouTube, and then I woke up on the morning of the 17th, right? And I saw that the Token Metrics all exchange index, right? So the AI goes out and looks through all exchanges and gives you its 8 best coins, and they were all stable coins. So I'm
Yeah.
sitting here at 5:45 in the morning on Central Time, looking at our AI going, you know, wrong. It's going lower, right? But the show's not until 1 p.m. No, the best way to stay out of trouble is tokenmetrics.com, because
Yeah.
it keeps me out of trouble.
Yeah, looking at, I mean, even in our newsletter that we're sending out today to our subscribers, is we show that the AI can predict these big leg up or leg downs in the market 2, 3, 4 days before they actually occur. So yeah, if you follow the bearish and bullish signals, that can definitely help you out.
Definitely.
But yeah, I think we can wrap this one up nicely. I think I would love to say to all of you watching, please smash that like button. Let's try to get this video to 100 likes. Should be pretty easy. Yep, there we go. I think that's a small goal.
Do it.
Yeah, maybe 200 likes, but I think right now we can set a goal of 100 likes on this video. Share it to your friends. If you're listening on your favorite podcast audio platform, we thank you for being here as well. Make sure to subscribe on YouTube and check out tokenmetrics.com. Thank you so much for watching, and have a great weekend.